All right, I think it's time to get moving along. Welcome, everybody. My name is Bob Bauer. I'm the president of AFI. For those who aren't familiar with us, the Association of Food Industries is the U.S. Food Import Industries Trade Association. We've been around since 1906. I've been with AFI since 1996 and serving as president since 2002. Just want to give you a quick rundown just in the past few weeks and days of stuff that we've been doing. I'm going to ask everyone to mute their lines. If you mute yourselves, we won't get the feedback. Looks like Brian. Thank you. All right, so we got a lot of folks joining at the moment as well. Just to give you a quick look at what AFI is all about. If you just look at the last couple of weeks and coming days, what we're involved in and taking care of. I spoke at and AFI had a booth at Seattle America Show. We have this webinar today, tomorrow, and Thursday. We're running an FSVP class. For those who haven't taken the FSVP class, it's something you definitely want to take a look at. And then next week we have our annual conference. So, some excellent speakers on tap for that. And in terms of products, just in the last couple of days, I've been helping people. We do topics of products with honey, olive oil, juices, frozen vegetables, cashews, HACCP, FSVP, and customs broker issues. So no matter what it is, AFI is they're trying to help out, and it's one of the reasons that we've been able to be around since 1906. So for those who aren't familiar with us, I encourage you to take a look at afius.org to take a closer look and see what we're all about. One of the sort of unexpected benefits sometimes for member companies is the resources that our associate members become. And today is an excellent example of that. So we have an associate member firm that specializes in a particular area, and they're able to share that expertise with us and in person. They'll be there next week at our conference, and they'll be able to, the importers will be speaking with them directly over the couple of days at the conference. So a tremendous resource. So we're really excited that we're able to partner today with Coface. And with that, I'm going to turn it over to Stephen Wright from Coface, who's going to lead us into the remainder of today's webinar.
Great. Well, thank you, Bob. We really appreciate on behalf of you and all of AFI for this opportunity to share a little bit of expertise about things that are going on in the marketplace right now. So my name is Stephen Wright. I'm with Coface. We're a trade credit insurance company. And for those that might not be entirely familiar with what trade credit is, we insure businesses' accounts receivable balances. So if you sell a product or a service to your buyer on terms, and you create an outstanding risk of repayment, we insure those balances. If your buyer does not, if they have protracted default, or they're late in making a payment, or they run into insolvency issues, the insurance policy would cover you as the policyholder and then institute a collection effort toward the buyer. We are AFI members and honored to be here today. I've got two of my colleagues, Ruben and Derek, here to present to the group around economic conditions and a little bit around risk evaluation for the food and agro industry. And look for about 15 minutes from each of my colleagues in their presentations, and we'll open it up for questions and answers accordingly. So with that, I will turn it over to our first presenter today, Ruben Nizard. Thank you, Ruben.
Thank you, Stephen. Thank you, Bob. Thank you, AFI, for this opportunity to speak. Really happy to be here today. For the next 15 minutes, my presentation will focus on 3 questions, and I'll try to answer 3 questions. So the first one will be, what is the outlook for the global economy? The second one will be, what is the outlook for the US economy? And the third one will be about the agri-food industries and condition in the agri-food industry, touching on some specificities for the US market. Derek will then also develop a little bit more on that. My name is Ruben Nizard. I'm Coface Economist for North America. So I'll start today with the outlook for the global economy to start things off. So packed agenda. Hopefully, we'll be able to cover all that in 15 minutes, and I'm looking also forward for your questions a bit later. But let's start. Let's start with global conditions and the global economic outlook. So when we look at the global picture, after a strong rebound from the recession triggered by the COVID-19 pandemic in 2020, we've seen a strong rebound. But now growth and global economic activity is slowing. You can see in 2022, 3.1% after 6% in 2021. Most of the reasons for these slowdowns are well known, and you're probably aware of them. Reverberations of the war in Ukraine, particularly in Europe, inflation, tighter monetary policy also impacted the outlook. For 2023, we still expect these conditions to weigh on economic activity, and we expect economic growth to slow further at the global level and to reach 2% in 2023. To put that in perspective, 2% at the global level, growth has been only 4 times in the past 25 years at 2% or below. That was in 2001, that was a global recession. That was in 2008 and 2009, great financial crisis. That was in 2020 because of the COVID-19 pandemic recession. So 2023 is already looking like a weak year. Most of the growth that we'll see in 2023, in our opinion, will come from emerging markets. Most prominently, we'll see growth coming from China as China rebounds from its zero COVID policy, and economic activity is expected to gain some momentum. India is also expected to perform better in 2023. So these factors already, and these 2 countries together, will account for about half of global economic activity in 2023. Resilience from emerging markets will also come from commodity exporters, minerals, agricultural, or energy commodity exporters, which are expected to weather a bit better in this environment as commodity prices, and we expect commodity prices to remain high. So most of the slowdown will actually be driven by advanced economies, and most notably by Europe. Europe, which has avoided the worst case scenario of a full-blown energy crisis, but reverberations of the war in Ukraine being cut from the supply of Russian gas already had an impact on pricing and manufacturing activity, and we've already seen some slowdown in these sectors in Europe. And we expect some more weakness going forward as inflation and tighter monetary policy continue to weigh on the outlook for Europe. These conditions of high inflation and tighter monetary policy are also the main topics in the US. So, which brings me to the second question on the outlook for the US economy. So, as you know, inflation has been the main topic in the US economy for the past 2 years. Inflation has reached a 40-year high early in 2022. In June 2022, more specifically, the consumer price index, one of the mega gauge of inflation, reached 9.1%. The good news is that over the past 6-9 months, what we've seen is a decline in this very high inflation rate. So there are several factors that have played into a slowdown in inflation. We have seen notably energy prices ease somewhat from their peak levels following the war in Ukraine and the beginning of the war in Ukraine. So this has contributed to a decline in inflation, as you can see on the left-hand side chart. Another key aspect has been some easing in supply chain disruptions, supply chain bottlenecks that have also helped to ease inflationary pressures. But while inflation has come down from its peak, it's still very high. 6% year on year as of February of 2023. So still way higher than what the central banks and the Federal Reserve is targeting, 2%. And there are some worrying signs that might signal that inflation is sticky and here to stay with us. Most notably, when we look at this left-hand side chart, we can see that the contribution from services to inflation has increased in 2022 and is still fairly high. And these service inflation is likely to continue through higher inflation than before the pandemic. So this is the concerning aspect on inflation. And that's why we expect that although inflation will continue to decline in the coming months in 2023, it is likely to remain above the Federal Reserve's 2% target. To try to counter this inflation, the central bank and the US central bank has acted very forcefully by raising interest rates. Why? Raising interest rates helps to slow demand, and then it brings back supply and demand back in balance in theory, and then it can help to ease these inflationary pressures. So that's the sense of their actions. And they've acted very forcefully. Since March of 2022, when they did their first 25 basis point increase, they've increased rates by 475 basis points. You can see that when compared to previous tightening cycles in recent history, that's one of the fastest that we've seen. Even when we compare it globally, the current tightening cycle has been, and the US has been leading the monetary tightening cycle globally. But when we look at 2023, with inflation slowing a little bit, with signs of economic activity slowing in the US, I'll talk a bit more about it in the next slide, while the Federal Reserve is likely to raise interest rates one more time by 25 basis points in May before pausing. But what this means, and because of inflation being high and the risk of inflation being higher than their target for throughout 2023, they are likely to keep interest rates at restrictive level for economic activity. So this is likely to keep us in an environment of low economic growth over the short to medium term. And actually, when we look at the activity momentum in the US, it has already slowed. It has already responded to some of this tightening and to this higher inflation. When you look at the left-hand side chart, you specifically have components of private sector spending. So more than 80% of US GDP. And you can see that in 2022, the growth rates are just above the waterline, just above zero. That signals already an economic activity that has slowed meaningfully. At the same time, it's important to note that the US economy has remained above that waterline and that it has avoided a recession so far. Some sectors have been hit hard, including the housing and real estate sector, where we've seen decline in residential investment. We've seen declines in home sales by more than 40% from their peak levels in the US as a result of higher borrowing costs feeding into higher mortgage costs in the US. So this is having an impact. We're also seeing signs of the slowdown and they're gaining momentum in recent months in the manufacturing sector, which is also very responsive to interest rate hikes as business spending slows in times of higher interest rates. And you can see with this, with a survey of purchasing managers that manufacturing conditions are now below the 50 lines, which represent a contraction in the manufacturing industry, which are actually being confirmed by hard data. But at the same time, when we look at the overall activity, it has still held up above the waterline and has been able to avoid a recession because economic activity in services has remained buoyant and has remained kind of resilient to the adverse economic environment brought by higher inflation and higher borrowing costs. There are also other factors that have helped to keep spending afloat on these services over the past few months, and that are likely to continue to provide a cushion against high inflation and higher borrowing costs in the coming months, and in my opinion, could help the US avoid a recession, narrowly avoid a recession in 2023. So these factors, they include a very resilient labor market with unemployment rate being very low. We've seen it has supported income growth, and this is supportive of spending for the US economy, and consumer spending is about 2/3 of US GDP. So it's a big deal for the overall state of the economy. And as long as this labor market, as long as spending holds up, the US economy will avoid a recession. In addition to this resilient labor market, well, households can also tap into savings that they've accumulated in 2022 and 2021 during the pandemic, when spending was being refrained by by restrictions associated with COVID-19, and when they received also government support that has helped to build a cushion of savings. You can see that already in 2022, some of these excess savings that have been accumulating in 2020 and 2021 have helped to cushion this impact. And this has probably played a role in the US avoiding a recession last year. And when we look at the trend in spending, if at current rate, there are still about 10 months left of spending for US households in their excess savings that they can use. So again, in our baseline scenario, there's no recession for the US, but the slowdown is coming, and we will be very narrowly close to one. And the recent turmoil in the banking industry is one of the headwinds that could add some more headwinds for this global economy, and could be one of the factors that contribute to keep the economy below the waterline in the coming months. More specifically, the banking turmoil could create tighter credit conditions, in addition to the already tighter credit conditions that are triggered by tighter monetary policy, which would in turn turn into lower demand and then lower economic activity. To conclude on the US, and before moving on to the agri-food outlook, just a word on bankruptcies and insolvencies, because this is a very important indicator for us at Coface, because it's a good indicator for credit risk and non-payment risks. I'm won't go into the details of the numbers, but what you need to know is that bankruptcies, after a period of being very low in 2020 and 2021 as a result of the post-pandemic rebound, we're seeing now these bankruptcies rebound. And in the second half of the year, we've seen quite a significant upward trend in bankruptcies that is likely to translate into higher risks of non-payment and higher risk of credit going forward in 2023, especially as we expect that the more challenging economic environment in the US will translate into a return to normal for bankruptcy level. So these slides kind of wrap things up. I'm not going to spend any time on it. The slides will be shared with you after the presentation so that you can take a look at this. But let's have a few words on the agri-food industry. So the agri-food industry at the global level, you can see that in different regions, we have sector risk assessments. So, and for the globe, you can see that the agri-food industry is either in medium or high risks. Actually, most of the regions before the war in Ukraine were in medium risks, but especially in Europe and in Middle East and Africa, we believe that the impact of the war on food supply had a negative impact on agri-food. North America has proven more resilient, as I'll touch on a bit later, but you can see that in the United States and in Canada, because the impact on the supply situation has been lower, because they depend less on supply from Russia and Ukraine, they've avoided this kind of downgrade that we've operated in other regions. They've also had better crop years after after dry conditions in some part of the country. So that's what explains that we still have an average or medium risk outlook for the US agri-food industry. So just to say a few words on the conditions, what we've seen is that in the context of the recovery, the war in Ukraine has triggered like massive threat on global supply, because Russia and Ukraine are major supplier of key agri-food commodities. Just to give a few examples, in 2021, Russia and Ukraine accounted for more than a third of wheat exports. They accounted for more than half of sunflower oil exports, for example. So, of course, when the war started, it had an impact on global prices. So what you can see with the indexes on the left, prices surged. Now, prices have declined in recent months as we've seen the Black Sea grain agreement, in particular, that allow the flow from Russia and Ukraine to continue to the Middle East and Africa to continue, and to ease some of the supply fears that we had right in the few weeks after the war started, has helped to ease some of these concerns, and prices have come down a little bit. But while they've come down a little bit, they remain way higher than they were before the pandemic. And more concerning, in our opinion, is that the supply situation will likely remain tight on the in the food industry and in the agri-food space. You can see that global projections for cereals production is expected to decline this year between 1% and 2%, according to estimates. And it will be mainly a result of reverberations, again, of the war in Russia and Ukraine. And this will exert upward pressures and will keep a floor on prices. So this is having an impact throughout the supply chains, because while it's positive for farmers, it is less positive for food processors and throughout the agri-food supply chain. In addition, what we'll look at when we look at the agri-food industry is also the cost structure. And we've seen cost structure for most food producers increase, particularly as we've seen energy prices and fertilizer prices also increase. And the same thing that I said about agri-food commodities is true for energy and fertilizer prices. Considering that Russia plays an important role in both markets, prices are likely to stay higher than they were before the pandemic, keeping a floor on inflation and on the cost structure of farmers. And indeed, what we've seen already in last year is that for the farmers, the prices that they paid for these key inputs have increased. And this is what you can see with the left-hand side chart. And this came also at a time when labor shortages were exerting upward pressures on wages and hence on labor costs for farmers. And also interest rates are rising as a result of the Fed monetary policy tightening, which is also an addition to cost. So this is adding cost pressures for producers that are likely to continue in 2023. And you can see that in 2023, net cash farm receipts are expected to decline from their 2022 levels because of these higher cost pressures. So before concluding, just a couple of remarks also on the demand situation for the food industry, especially in the US. Of course, the inflation environment has been also true for food. And we've seen grocery prices increase very fast, even faster than the average rate of inflation. You can see that food prices for food at home was still 10%, about 10% higher than before, than a year before. And prices for food away from home, especially at restaurants, is also very high, more than 8% compared to last year. So this is impacting consumers' behavior, of course. And what we've seen is that notably when it comes to retail sales at food and beverage stores, most notably grocery stores, we've seen since the beginning of 2022 that a softening and a change in consumer behaviors, with consumers favoring cheaper options. We've seen sales decline and sales volume also decline. At the same time, what we've seen, and this is an interesting aspect, is that despite challenging situations for households and their financial situations with high inflation, and including on their restaurant bills, well, we can see that the reopening of the economy has supported some demand in sales at food services and drinking places. So we've seen this recovery continue over the past few months, despite some ups and downs here and there. The recovery has continued as pent-up demand on these kind of services remain high after the pandemic. So not yet a material impact on consumption at restaurants in the US. And to conclude, also just a word specifically for this audience, which is especially in the food industry, in the food import space, to show some long-term trends. In the US, when we look at the past 15 years, we've seen an increasing share of consumptions that come from imports. And this is mostly linked to some specialty products and some processed product, as you can see on the right-hand side chart. More specifically, we see beverages, for example, that are a key driver of this rising import value share of food and beverage consumption in the US. But it's also interesting to note that some specific non-manufactured food products are also finding their way and are playing an increasing roll into the consumption of US households, and this includes nuts and vegetables, including exotic nuts and vegetables. So this is it for my presentation. Again, there is at the end here a slide to wrap things up. If there are any questions at the end, I'll be happy to take them, but I'll hand over the presentation to Derek, who will go a little bit deeper into condition in the US agri-food industry. Thank you.
Sure. Thank you, Ruben. And of course, thanks, Bob and AFI for giving us the time here and getting together for this presentation. We're going to go ahead and share some more information. Let me share my screen 1 second. One second, sorry. And hopefully everybody can see my screen here and hear me okay.
Yes.
Yes.
So my name is Derek Baldwin. I'm a senior risk underwriter here at Coface, specializing in agri-food, also with the retail sector. So we're going to go ahead and go over some slides specific to what we're seeing in agri-food, what we saw in 2022, what we're seeing now, what we're expecting to see through 2023, how that's impacting some of our customers, what we're seeing in the sector, and I can touch base a little bit as far as payment trends, any impacts on credit limits we're issuing, monitoring, and kind of help you get a good grasp and outlook on what we're seeing in the credit market specific to agri-food. So here, a lot of these are going to be kind of some of the same touch points that Ruben just mentioned on. Inflation, I think that's the biggest topic we're seeing here in this sector. So of course, with the post-pandemic environment, we saw labor costs skyrocket. We see inflation, we see supply chain disruptions in volatile markets. You can see there in the chart, I just use this as an example, but it's sugar. And you can see the price of sugar going up significantly recently. And that's just an example. We've seen that through wheat, we've seen it through grains. I think we've all seen it through grocery stores when we go to the restaurants. It's kind of the theme through 2022 and how that's going to moderate in 2023. Now, what typical companies and entities that we're seeing in the supply chain, how they're offsetting that inflation is increasing their pricing. So you're seeing costs increase, you then increase pricing, and you're able to maintain your margins. That's kind of the main, I would say, risk factor that we monitor right now, is the ability for companies to pass on these costs, how they control the market, and again, maintain their margins and their profitability. So another factor, of course, is with inflation, consumers, how much they're going to spend and what they're buying. You're going to see a shift from eating out more often to staying at home, making dinner at home, buying what we call private label brands, store brands, kind of the cheaper alternatives, which that can then impact margins as well. So I'm going to kind of touch base on a few what we call subsectors within agri-food. I think this is going to tailor to our audience pretty well here, and some of the end markets we see in the sector. The first one is grocery. So of course, this is typically grocery stores. It's controlled by a lot of the bigger players, Kroger's, Whole Foods, and so forth. So what we're seeing is they control the market, so they have the ability to set prices. So when you have the ability to set prices, they can increase pricing, and consumers so far have been absorbent of that. They haven't reacted. Of course, typically we need food, but so, you see some of these increases with eggs, bread, basically anything across the board. There's double-digit year-over-year increases in pricing. Eggs are up over 30%. The typical take-home food is up 12% on a year-over-year basis. So grocery, the end markets are what we consider a strong subsector. Again, it's consistent demand from consumers. What we're seeing is their ability to pass on higher costs, maintain their margins. And for the most part, what you see in 2022 and through 2023 so far is record profits, record revenues. Kroger's reported record profits last year. So that's what we consider kind of a positive or a green light subsector within agri-food. Pretty strong positive underwriting from a risk standpoint. Packaged foods, that's another one that's kind of I would call it a mixed bag. It's benefited from at-home food consumption. So of course, lifestyles have changed. Individuals work from home. It's not the, I guess, stereotypical 9-to-5 office lifestyle anymore, to where you might be eating lunch, out. So what you're seeing is demand there. You're seeing top line growth because consumer demand is high. For the most part, they're able to offset margins offset costs, maintain their margins as they control a portion of the market. As you can see, revenue is expected to increase mid to high single digits in 2023 as they kind of continue to increase pricing to offset those higher costs. Again, what we're monitoring here from a risk standpoint is really the input costs and what they're going to trend or track throughout 2023. Because there's a lag, of course, in offsetting increasing pricing to offset the costs. Casual dining. So casual dining, as Ruben mentioned, kind of expecting a possible recessionary environment. So consumer spending is down, a little bit more conservative, more dinners at home, less eating out. So you see the demand from consumers down. So a volume softness is expected. Also dining, it's a highly competitive market. They don't have the ability as, let's say, a grocery store to pass on high cost increases to consumers, since it's such a highly competitive market. And also they need to typically maintain what we call value offerings, kind of some of the specials and deals to keep the consumers coming in through the doors. So that's kind of what we consider a dual impact within casual dining. You could see lower demand from consumers. You can also see inflation, high costs impacting their margins. And then lastly, wanted to touch base on here is beverages. And beverages, as you can see, high price increases, 10 to 15% last year, up over 20% from pre-pandemic levels. Typically, you have players that control the beverage market, value-added products such as energy drinks, coffee drinks, tea drinks, low sugar options. Volume is expected to remain pretty flat through 2023 and stable margins as they're able to kind of pass on pricing as noted there in the top bullet point. Ruben mentioned kind of some of these topics as well. It's just an overview on agri-food imports, some of the trends we see. So really, as American consumers become more ethically diverse, really a smaller world that we live in, you have access to more tropical fruits, spices, different culinary products. As you can see by that graph there, the demand and imports have gone up and about 4% on an annual basis. So the US imports around 15% of our overall food supply, 95% of coffee, cocoa, spices, 94% of seafood, 55% of fruits, and over 30% of vegetables. So touching base a little bit here on trade credit insurance, as Stephen mentioned, it's a risk management tool. Ultimately, it safeguards and secures account receivables of businesses. It locks in your invoices. And as an underwriter, we typically look at a policyholder or a customer's book of business, look at their sales portfolio, and ideally cover 100% of that portfolio. So we'll look at all their customers, typically what their highest outstandings are in the past 12 months, what information we need to be able to issue that coverage, and then ultimately issue formal credit limits to policyholders. And here's kind of a high level approach on how we do risk underwriting. I always mention ultimately data and information is the most useful tool for us. So we have partnerships with a variety of information credit agencies, Dun & Bradstreet, CFAX. What we use those partners with is payment trends. We look at trade accounts, we look at high credits, we look at any reported bank financing information to go ahead and issue some credit limits as we can. We also look and partner with policyholders, customers, and debtors to obtain and review financial statements. So from that approach, we'll look at financials. We can typically issue higher credit limits. And then, of course, macroeconomic conditions, as Ruben covered. I covered more on the U.S. agri-food sector. We're always looking at, what's happened and where we're going within the macroeconomic environment. And here's kind of a high-level global view of countries' Coface issues credit coverage within and the outlook within each country. So, of course, green is a strong risk, very low default, late payments, while red is a riskier country, weaker local economy, difficult political obstacles. And then we'll jump ahead, kind of what we're looking at in 2023. We are starting to see internally within agri-food an increase in reported late payments, reported overdue credit accounts. Claims are up approximately 60 to 70% on a year-over-year basis within agri-food. So you're seeing kind of some of those issues within the sector as far as inflation impacting margins, some players in the supply chain not able to offset higher costs, maintaining margins, and some cash flow issues. So we're actively monitoring, of course, agri-food as we do any sector. We monitor commodity pricing, we look at inflation, we look at interest rate risk, and we really keep a close eye on company history, trade payments, ownership backgrounds for kind of the smaller suppliers in the supply chain. Larger, mid-size, and significant debtors, of course, are either public companies or we have a relationship that we source financial information through them to support credit limits to their vendors. And that's everything on my end from the credit risk underwriting standpoint. I think we can pass it back to Stephen if you want to conclude and open it up for Q&A.
Yeah, thank you. Thanks, Ruben, and thanks, Derek, both of you for your time and your preparation. Really strong presentations. And open it up to the audience at this point if there are any questions or feedback or need to review any information.
Hey, Stephen, this is Jake. Derek, Ruben, fantastic. Thanks for that info. And Bob as well. Thanks for, jumping in. Just real quick, you kind of mentioned that agri-food was, there was a lot of positives and then sort of also negatives that we're starting to see. So I just want to make sure I'm understanding correctly that it's doing well enough to be underwritten, but that it's sort of wobbly. So it's maybe a good time to underwrite some of that stuff, or was it more, not looking good, maybe steer clear?
Yeah, no, I can answer that. Good question, Jake. I think, of course, food demand will always be there for food imports, the supply chain. Sure, you might see some late payments, some overdue accounts being reported, but it's a strong sector. I think Ruben had a yellow grade or a yellow outlook on there because you have some subsectors that have its challenges. Example, casual dining, as we covered, but grocery, packaged foods, the demand there, and I think it's a positive outlook that's getting stronger as inflation moderates.
Okay, great. I just on my end wanted to just make sure I was understanding correctly. So thank you. Thanks again.
Any other questions from our audience? All right, I'll turn it back over to Bob for conclusion, but again, thank you, Derek, thank you, Ruben, just for our larger group here. As Derek mentioned, I think the takeaways here are nothing happens overnight, and nobody is overly alarmed about our sector here in agro and food. Starting to see some effect of economic conditions on late pays and trickling in on some smaller company bankruptcies and insolvency issues. So certainly something to be aware of within our industry here, but no need to press the panic button at this time. I think, demand in our sector will always remain high and resilient and survivable through difficult economic conditions. So I would say, we've got a positive road ahead of us, even though we may be, riding a bumpy ride at the moment. But again, Bob, thank you to you and to AFI for this opportunity to kind of share our knowledge and our wisdom.
All right, thank you, Stephen. Appreciate all of your work, and let's see, Ruben and Derek also for your individual contributions, and the whole Coface team. One thing I always like to mention at the end of something is the session doesn't necessarily end now. If you have any follow-up questions, we can either get them to the folks at Coface, or you can reach out to them directly. As was noted, you'll get the copy of the slides. What we're going to do is send you a link to the recording of the webinar, and that email will also include the presentation, so you'll have that going forward. And with that, I'll give one last chance in case anybody has any questions that come to mind now. All right, well, hearing none, then we will wrap it up. I thank you all for joining us today, and look forward to seeing you all soon.
Thanks again, everyone.
Thank you.
Thanks so much.
Thank you, everybody.
Thank you.
Thank you.